We need to talk about a number. 168.
168 hours,
Mm-hmm.
to be exact.
Yeah, exactly. Because that is the precise amount of time. The window between last Thursday, January 29th, and right now, today, Thursday, February 5th.
And in that window, just utter devastation.
It's the single most violent wealth destruction event I think we've ever seen in the precious metals market, at least since, the Hunt brothers got cornered back in the 80s.
The numbers are just, they're staggering, a 48% drawdown. But honestly, even saying 48% feels like it softens the blow.
It does. It makes it sound like a statistic, like something in a textbook.
Right. It's not a statistic. You have to look at the market cap that was just vaporized. You have to look at the sheer violence of the move on the chart. It's not a line, it's a cliff.
Okay, so let's set the scene properly before we even open the file on this. 7 days ago, 1 week, silver was trading at $121.62.
An all-time high.
An all-time high. You had every newsletter, every talking head on TV, every single retail trader on Twitter just screaming about a supercycle.
Oh, yeah. The narrative was that the train had left the station for good. Yeah. If you weren't on, you were going to be left behind forever.
And now, 168 hours later, we're looking at an intraday low of $63. A $63 handle. It's almost unbelievable.
And the source material we pulled together for this deep dive, I'm talking about the CME order flow data, the technical breakdown of the leverage flush, and this Warsh Shock dossier, it all suggests something really important.
What's that?
This was not a correction. This was not just people taking some profits off the table to, buy a new car. The term that keeps coming up is a forensic liquidation.
Forensic liquidation. I saw that. It appears 3 times in the notes. It sounds so clinical, right? So detached. But when you look at the charts, the reality is it's messy. It's just bloody. And that brings us right to the core conflict of today's deep dive. Because I have to be honest, I'm looking at this chart, and the believer in me, the guy who's been tracking the silver deficit for years, that part of me is just screaming, buy the dip.
And that's a perfectly natural reaction. I get it.
It feels like the sale of the century. I mean, we're down almost 50% a week.
Yeah.
My gut, my instinct is telling me we need to mortgage the house, back up the truck, and try to catch this falling knife. Because the V-shaped recovery from this is going to be absolutely legendary.
And I have to tell you, that instinct, that exact muscle memory that traders have built up over the last 2 years of buying every single dip no matter what.
Yeah.
That is precisely what is going to get people absolutely destroyed in the next 48 hours.
Whoa. Okay. So you are taking the other side immediately. No hesitation.
I have to. Because the mission for this deep dive, for what we're doing right now, is to open this file and figure out if $63 is actually a floor, a solid foundation you can build on, or if it's a trapdoor.
A trapdoor.
And, spoiler alert, all the data, especially around the structural changes in this market, it suggests the momentum is completely dead.
Dead. Like dead.
Comatose.
Wow.
The Warsh Shock, which we'll get into, and the CME margin changes, they've fundamentally altered the physics of this market. So I think $63 is just purgatory.
Purgatory.
Yeah. If you buy here, you're not a hero.
Yeah.
You are likely just providing the exit liquidity for the institutions that are still trying to get out.
Yeah.
I believe the real target, the only place where it's even remotely safe to think about re-entering this market, is what the notes call the October ghost level.
And what level is that?
$54.
54. Wow. I mean, that feels miles away from here. That feels like a different era entirely.
It's closer than you think, and we're going to break down exactly why.
All right, let's do it. Let's get into it. Part 1, the crime scene. We have to really dissect the anatomy of this thing, the melt-up and then the meltdown. Because I don't think you can understand why we're at 63 if you don't first understand the absolute insanity of 121. So take me back. January 29th, what was the feeling?
Euphoria. I mean, there's no other word for it. Pure, unadulterated, weapons-grade euphoria. But let's look at the math underneath that emotion.
Okay.
If you look at the technicals from that day, the RSI, that's the relative strength index, it was screaming at 93 on the daily chart.
Okay, let's pause there for a second. I want to make sure everyone listening really gets the gravity of that number. A normal RSI, it ranges from 0 to 100, right?
Correct.
And usually anything over 70 is considered overbought, like the move is getting a little stretched.
Just a 70 is overbought.
Yep.
80 is what we'd call extreme. You might see 80 once or twice a year in a really strong bull market. It's a sign that things are getting hot.
So what is 93?
93 is a statistical anomaly. It's a ghost. It's 3 standard deviations outside the mean. It implies a market that has completely, utterly detached from any sense of reality or valuation.
So what does that actually tell us about the people who were buying that day? What was their psychology?
It tells us that everyone who wanted to buy had already bought. There were literally no sellers left in the system. That's the technical definition of a meltup.
Wow.
It felt invincible. The price was just going up vertically every single hour. But the whole time, the foundation was completely hollow. It wasn't built on new investment. It was built on pure, unadulterated leverage.
I remember looking at the screen that morning. It was hypnotic. The dollar index was crashing. Gold was up, and silver just seemed to be teleporting higher. And you get sucked into the narrative, right? You start thinking, this is it. This is the currency collapse everyone's been warning about.
Exactly. The narrative completely takes over the math. But the danger of an RSI at 93 is that the air is incredibly thin up there. It doesn't take much at all to tip the whole thing over. It's like you're standing on the absolute peak of Mount Everest, but you're on one leg.
A gust of wind could just end you.
A gust of wind could kill you. But what happened here wasn't just a gust of wind. This was a calculated, deliberate shove.
And that shove brings us to the drop, the crash down to 63. And this is part of my believer case, right? Usually when markets correct, they staircase down. You get a dip, then some value buyers step in, you get a little bounce, then another dip. It's orderly.
Yeah.
This was an elevator shaft.
It was a total collapse.
Yeah.
And this is precisely where your oversold argument starts to fall apart.
How so?
Because you look at that vertical drop and you think, okay, the reaction is too severe, it's overdone, it has to bounce back hard. And that logic applies perfectly to a market that is functioning normally.
And you're saying this isn't a normal market anymore?
No. This is a systemic liquidation. And there's a massive fundamental difference between selling and liquidation.
Okay, break that down for me.
Selling is a choice. Selling is when you decide, you know what, I've made a good profit, I'd like to buy a house, so I will sell some of my silver. You are sensitive to the price. If the price drops too low, you stop selling.
Right, you have agency. You have control over the decision.
Exactly. Liquidation is when you have zero agency. A liquidation event is a vacuum cleaner. Liquidity, the actual cash available to buy assets, was sucked out of the system entirely. And when you have a liquidation event, the price doesn't care about oversold or undervalued.
So what does it care about?
It only cares about one thing, finding a buyer who actually has cash. And right now, the leverage flush has wiped out all the cash.
Okay, so let's play devil's advocate here. I'm going to put my believer hat back on just for a minute.
Go for it.
I'm looking at the chart today. I see $63, and I see that we are sitting almost to the penny right on the 200-day moving average.
Which is a classic textbook technical support level. I'll grant you that.
Exactly. It's the proverbial line in the sand. Every textbook you'll ever read says that when a major asset hits its 200-day moving average, that's when the big institutions, the smart money, that's when they step in to defend the long-term trend. And on top of that, the FOMO, the fear of missing out, is just eating me alive. If I don't pull the trigger at 63 and tomorrow we wake up and silver's back at $80, I am going to hate myself. I miss the easy money.
Easy money. See that phrase right there? That is the siren song that has led to this entire shipwreck. Let me try and dismantle the believer case for a second, piece by piece.
Okay.
You look at the chart and you see a discount. You see a bargain. I look at the same chart and I see a falling knife. And not just a falling knife. I see a blade that is falling point down.
That's a terrifying image. But why is it a trap? Why wouldn't the big banks and the hedge funds step in to defend the 200-day moving average like they always do?
Because the banks aren't the ones who got caught with insane leverage. The analysis we have describes this $63 level specifically as a trap. And it's because of the volume profile.
Okay.
On one side, you have that golden timestamp of January 29th. It was shiny, bright, euphoric. But on the other side, when they describe this $63 level, the source material calls it a dark, foggy basement.
A basement.
Think about it. We fell from the penthouse at 121, crashed through the living room floor in the 90s, blew past the first floor in the 70s, and now we are in the basement. The danger of catching a falling knife down here is that you assume someone else is going to be there to help you catch it.
You assume the institutions are stepping in.
You assume they are. But ask yourself, why would they?
Well, because it's cheap compared to where it was a week ago.
Cheap is relative. If you're a major bank and you know for a fact that an entire generation of retail traders is trapped long and is being forced to sell, Why on earth would you buy from them at $63? You'd wait. You'd wait. You would let them panic. You would let them bleed out until the price hits your target, not theirs. The institutions are not stepping in at 63. The only people who are active at this level right now are the retail traders who are trying to save their underwater positions. They're averaging down. They are praying for a bounce.
So if I buy here, I'm basically just standing alone in a dark basement with a bunch of other panicked retail traders, and collectively, none of us have the capital to actually stop the slide.
Precisely. You are providing the liquidity for the few lucky people who are still able to get out.
Yeah.
You aren't catching the knife. You are the exit door.
That's incredibly sobering. But okay, we have to understand the mechanics here. We can talk about sentiment and basements all day, but money doesn't just evaporate without a mechanism. You mentioned the bouncer earlier.
Right. This is absolutely critical. To understand why we crashed with such velocity, you have to look at what happened on Monday, February 2nd.
The day the music stopped.
That is the perfect way to put it. The CME Group, the Chicago Mercantile Exchange, the entity that actually runs the silver futures market and sets the rules, they raised the margin requirements.
Okay, let's unpack margin for a second. We hear this term thrown around all the time, but I want to make sure we really nail the math here for everyone listening.
Sure. So when you trade silver futures, or when you're trading with high leverage on some of these retail platforms, you don't actually put up the full value of the metal you want to control.
Right.
If you want to control, say, $100,000 worth of silver, you don't need $100,000 in your account. You just need a good faith deposit. That deposit is the margin.
It's like a performance bond, basically.
Exactly. It proves you have some skin in the game. Well, on February 2nd, the CME raised that required deposit from 11% to 15%.
Now, hold on. I can hear the listener at home saying, wait a minute, 11% to 15%, that's only a 4% increase. Why would that nuke the entire market? That sounds like a rounding error.
And that is a perfect example of linear thinking in a completely nonlinear environment. You can't just look at the 4%. You have to look at how it impacts the leverage ratio.
Okay.
At 11% margin, for every $1 of actual cash you have in your account, you can control roughly $9 worth of silver. That's a 9-to-1 leverage ratio.
That's the rocket fuel. That's how people were doubling their accounts week after week in January.
It's pure rocket fuel. But when the CME hikes that requirement to 15%, your leverage ratio suddenly drops to roughly 6.6 to 1.
So wait, let me just run the napkin math on that. That means the total purchasing power of the entire market contracted by, what, almost 30%?
Almost exactly. Just think about that for a second. Even if nobody sold a single ounce of silver voluntarily, the simple capacity for the market to hold its open positions shrank by 30% the second that rule change hit the terminals.
This is the bouncer stepping in.
Yes. Let's use the analogy from the source material because it's perfect. The rally up to $121 was like an exclusive high-end club.
Okay.
Everyone was inside partying, the champagne was flowing, the leverage was the alcohol making everyone feel brave, and the cutter charge, the margin requirement, was really low, so everybody could get in, even people who didn't really have enough money to be there. They were in the club, dancing on the tables.
That was a rager.
It was a total rager. Then suddenly, mid-party, the bouncer at the CME walks into the middle of the room, cuts the music, turns on all the ugly fluorescent lights, and gets on the microphone and announces, "Attention, everyone! The cover charge just went up, effective immediately."
And if you don't have the extra cash in your pocket.
If you didn't have that extra capital in your pocket right that second, the bouncer grabs you by the collar and physically throws you out into the street.
And that is a forced liquidation.
That is the definition of a forced liquidation.
Yeah.
You don't get a choice. You don't get to say, hey, can I pay you next week? You are out. And in the futures market, getting thrown out means your position is sold at the market price.
So the bouncers team literally sells your silver for you, and they don't care what the price is. They just hit the sell button.
Yes. And this is what creates the mechanical cascade. This is the answer to why the chart looks like a straight line down instead of a staircase.
Okay. Walk us through the steps of that cascade. How does one person getting kicked out of the club trigger the whole room getting cleared out?
So, step 1. The margin hike hits the system. The most leveraged traders, the people who are leveraged to the absolute max with no extra cash, they get kicked out instantly. Their silver positions are market sold.
Which obviously increases the supply of silver for sale and pushes the price down a little.
Right. Let's say that initial wave of selling drives the price from 121 down to, say, 115.
Okay, makes sense.
Now we get to step 2. The traders who could afford the higher margin at 121 are suddenly in trouble. Because the price is now at 115, their account equity has dropped. Their collateral is worth less, which means their leverage ratio just spiked back up.
Oh, I see. The dropping price makes their remaining margin insufficient all over again.
Exactly. So now they get a margin call from the bouncer, which leads to step 3. Those traders are now forced to sell. That selling drives the price down to, let's say, 105.
And that triggers the next group.
Step 4. The next tier of traders gets the call. It is a completely self-feeding loop of destruction. The selling triggers lower prices, which in turn triggers more forced selling.
And that explains the incredible speed of the collapse. This wasn't humans making emotional decisions. This was algorithms and risk management desks just automatically liquidating positions as their triggers were hit.
Precisely. It was a machine. And that machine deleted an entire generation of retail traders in 168 hours. It wasn't about sentiment or fundamentals in that moment. It was about cold, hard math. If you didn't have the cash, you were gone. End of story.
But here's the thing that's bothering me about the CME. They're the bouncer, I get it. But usually the bouncer doesn't just decide to ruin the party for no reason. They usually act because things are getting too rowdy. Or because the owner of the club told them to crack down.
Correct. The CME doesn't operate in a vacuum.
So there had to be a fundamental catalyst, right? A macro reason why the environment suddenly changed so drastically. And all the source material points the finger at one man. Or rather, one nomination. The Warsh Shock.
Kevin Warsh, the nominee for a key seat at the Federal Reserve.
Now, I want to push back on this Warsh Shock theory for a second because it feels a little too simple. Are we really pinning a 50% market crash on a single nomination? Kevin Warsh is just one guy. He hasn't even set a policy rate yet. He hasn't printed a single dollar or burned a single dollar. Is the market really that fragile that a nomination can shatter the windows?
It's not about the man himself. It's about the signal he sends. You have to understand what the market was pricing in before that Monday. For the better part of a year, the entire market has been running on one fuel source: easy money. The central idea was that the Fed would let the economy run hot, keep interest rates at zero, and basically inflate away the massive national debt. That assumption was the fuel for the $121 fire.
The heaters you mentioned.
Yes. Let's go back to that room analogy because it's perfect here. The market on January 29th was a room, a small, crowded room. And because of all the leverage and that powerful inflation narrative, that room was heated to 121 degrees.
Sweltering. Uncomfortable.
But everyone inside was getting used to the heat. They thought this was the new normal. They thought silver was supposed to be at $120 because the dollar was on the verge of collapse. Then Kevin Warsh gets nominated.
And he's not an easy money guy.
He represents two things explicitly: a strong dollar and a shrinking balance sheet. He is the quintessential anti-inflationary candidate.
He's basically Volcker 2.0.
He is. So when he gets nominated, he doesn't just walk into that hot room and politely turn down the thermostat. The analogy in the file is that he kicks open the door and turns on industrial-sized air conditioning.
Ooh, an instant freeze, a thermal shock.
The heaters, that entire easy money, high inflation narrative, were turned off in a nanosecond. The market had an immediate collective realization. Wait a minute. If the future is a strong dollar and higher real interest rates, then silver isn't an inflation hedge anymore. It's just an industrial metal.
And an industrial metal has no business trading at $121.
Exactly. The consequence of turning on industrial AC in a 121-degree room is that the thermal shock shatters all the windows. That's the crash. The entire environment has fundamentally changed. And this is the critical piece that the buy the dip crowd is completely missing. They think the heaters are just paused for a minute.
They think we'll go back to 121 degrees next week.
Yes. But the building management has ripped out the old furnace and installed a brand new HVAC system. We are now, for the foreseeable future, in a strong dollar environment. The algorithm that priced assets has completely flipped.
So $63 isn't a discount. It's just the new room temperature.
It's the room temperature trying to find its new normal. But because the shock was so violent, because Warsh turned that dial from max heat to max cool so fast, we overcorrected to the downside. But here is the key realization everyone has to have. The heaters are off, and they are not coming back on anytime soon.
Well, that puts a pretty serious damper on my V-shaped recovery theory. If the fundamental driver of the entire bull market, which was inflation fear, has been neutralized by the Warsh nomination, then what on earth is going to push the price back up?
In the short term, nothing. That's the hard truth. Markets take the stairs up and the elevator down. We know that. But they also need time to rebuild the stairs after the elevator crashes. And that brings us to the verdict, the final destination, the October ghost level.
Okay, this is the part I've been dreading, but also the part I really need to hear. We have a clear disagreement on the target. I'm sitting here staring at $63, hoping against hope that it holds because of the 200-day moving average. You are pointing much lower, to 54. Why 54? Is that just a random number you're pulling out, or is there real math behind it?
It is entirely based on math. We have to look at a tool called volume profile. If you pull up the silver chart for late 2025, specifically the month of October, you see this massive, dense block of trading activity that occurred between $52 and $55.
Okay, I'm pulling up the mental chart now, October 2025. Yeah, that was that long, boring consolidation period right before the massive breakout.
That was the basement back then. The price just churned around $54 for weeks and weeks. Millions and millions of ounces changed hands in that tight range. It built a solid concrete floor. That was where the real accumulation happened.
So that's where the smart money, the institutions, that's where they bought in originally. That is their cost basis.
Exactly. Everything above $54. The entire run to 80, 100, 121. That was all low-volume froth. It was retail traders chasing the price higher. It was pure speculation. But $54, that level is concrete. That is where the institutions actually own the metal.
So when you say ghost level, you mean we're just returning to the scene of the crime, to the last place where real money actually changed hands on the way up.
Yes. It's a fundamental concept of market theory. Price tends to travel very rapidly through low-volume nodes, which is what we're doing right now, just slicing through the 70s and 60s like they're not even there, and it slows down and stops when it hits a high-volume node. $54 is a brick wall of liquidity.
This brings up a really terrifying concept for anyone who's still holding silver right now. If the institutions bought at 54, they aren't losing any money yet.
Not a dime. They're still sitting on a profit. And that is why they are not stepping in to save the price at 63. Why would they? They don't care about $63. They are patiently waiting for the price to come back down to them.
And the physical gap you mentioned in the notes, what's that?
That's the other side of the coin. While you're looking at the paper price on your screen at 63, the big industrial buyers, the Samsungs, the Teslas, the solar panel manufacturers, they aren't panic buying here either. They know all the speculative leverage has been flushed out. They are eyeing that gap down at $54 because that's what they see as the fair value for the physical metal based on current supply and demand.
Describe $63 to me again. You called it a purgatory zone.
It is. Just think about it logically. We just fell from 121. The downward momentum is absolutely crushing. $63 is just a pause. It's the 200-day moving average, yes, but because of the violence of the Warsh Shock, there is simply no air left in the room to support a meaningful bounce here. It's a shelf that's made of cardboard.
And if I try to stand on that cardboard shelf,
you're going to fall right through to the concrete floor at 54.
This brings up a really uncomfortable dynamic you mentioned earlier, the liquidity dynamic. I want you to look me in the eye, so to speak, and explain this, because I think a lot of our listeners are probably in this exact position. If I am holding silver that I bought at 120 or 100 or even 80, and I'm just refusing to sell because I'm a long-term believer, how am I the problem?
This is the single harshest, most difficult lesson of markets. If you are holding a losing position and you refuse to sell, you are what the professionals call trapped long. The market knows you are there. The institutions can see your positions. And eventually, the financial pain just becomes too much. Eventually, 63 breaks, then we drop to 60, then 58. You start to panic. You can't take the pain anymore. You finally hit the sell button.
And who am I selling to at that point?
You sell directly to the smart money that has had their buy orders sitting patiently at $54 the whole time. You capitulate at the absolute bottom, providing them with the cheap shares, the liquidity that they need to load up for the next cycle. They need you to panic and sell so that they can buy.
So my panic is literally their opportunity.
The smart money is not trying to be a hero and catch the falling knife at 63. They are coldly and calmly mapping the drop to 54. They have their orders sitting there just waiting for you and thousands of others to finally throw in the towel.
That makes me feel like prey.
In a liquidation event of this magnitude, the uninformed retail trader is the prey.
Okay. I refuse to be prey. I want to survive this, and I want to find the right opportunity. So what is the strategy? The notes call this the Pandora pivot.
Right, Pandora. Because once you open this box of liquidation, you can't just slam it shut. You have to let all the demons fly out first. But there is a pivot point. There's a moment of opportunity.
So, practically speaking, I'm sitting here. I have cash on the sidelines. I want to buy silver for the long term. Do I just sit on my hands?
It's got the play?
Yes. You sit on your hands. And that is the single hardest thing to do in trading and investing. Doing nothing is an active and, right now, a brilliant strategy.
The patience play. It is the ultimate patience play. Rule number 1, do not fight the bouncer. The CME and the Federal Reserve have spoken. The easy money phase is over. If you try to fight that overwhelming trend, you will run out of money long before they run out of policy.
So we wait. We wait for the test of $54.
We wait for 54, and then we watch like a hawk for the Pandora pivot.
What does that actually look like on a chart? How do I know it's the real pivot and not just another trapdoor on the way to 40?
This is key. You will not see a V-shaped bounce. Don't even look for it.
So no rocket ship straight back to 100?
No, absolutely not. The pivot will look like boredom. You'll see the price stop going down even when there's bad news. You'll see volume start to pick up, but the price doesn't drop any further. That's the signal. That means the big whales are quietly absorbing all the panic selling. They are eating the supply.
So you're looking for accumulation, boring, sideways, grinding accumulation.
Exactly. When the price hits 54 and it stops dropping and it just starts to grind sideways for a few weeks, that is the pivot. That is the moment when the physical demand for solar panels, for EVs, for batteries starts to matter more than all the paper speculation.
So the long-term bull run, it isn't actually dead.
No, the long-term bull run isn't dead at all. The fundamental reasons to own silver, the scarcity, the massive industrial use, the entire green energy transition, none of those have changed. But the V-shaped recovery is a complete myth. The market needs to rebuild its foundation. It needs to heal, and it can only heal at the ghost level.
It's like a broken bone, right? You can't just tape it up and start running a marathon the next day. You have to reset it properly. You have to put it in a cast and let it knit back together.
And $54 is the cast.
Okay, so to recap the strategy here, stop trying to catch falling knives. Stop looking at 63 as a discount. Start reading the floor at 54.
Do the smart money. Don't be the liquidity.
That is a very powerful takeaway. All right, we've covered a ton of ground here. Let's try and bring it all together in a final summary. This has felt less like a market analysis and more like an investigation into a crime scene, basically.
It really has. It's a forensic deep dive.
We started with the victim, the price of silver. We saw it go from the dizzying, euphoric heights of 121 on January 29th all the way down to what we're now calling the trap at $63 today.
A 48% collapse in market capitalization in a week. Just brutal.
We identified the mechanics of the crime, the CME bouncer who came in and hiked margins from 11% to 15%, which contracted the leverage ratio from 9 to 1 down to 6.6 to 1, physically forcing leverage traders out of the market.
And we identified the macro catalyst, the motive, the Warsh Shock. The air conditioning that completely froze market sentiment and changed the entire macro landscape from an inflationary easy money paradise to a strong dollar regime.
And finally, the verdict on the final location. $63 is dangerous. It's cardboard floor. $54 is the real target.
The October ghost level, the historical cost basis of the institutions, the concrete foundation.
I want to leave our listener with one final provocative thought, something to really chew on as they watch this play out, because we've talked a lot about the math, but the psychology here is just so brutal. This move from 121 to 63 in just 7 days, our sources estimate it wiped out 90% of leveraged retail traders.
Gone. Accounted zero. Years of savings just evaporated in a week.
That is an incredible amount of pain and financial destruction.
It is, but it also raises the single most important question for the next 6 months. If we are right and $63 fails to hold and we do get that final gap down to 54, are we looking at the buying opportunity of a lifetime? Is 54 the launch pad for the next incredible move to $200? Or is the air conditioning that Kevin Warsh just installed going to freeze this market for years to come? What if we hit 54 and the industrial buyers don't step in? What if the Pandora pivot doesn't actually happen? Then silver could become dead money for a very, very long time.
Is this a cold winter, or is this the start of a new ice age for silver?
Exactly. That's the multi-million-dollar question. If that industrial demand doesn't show up to defend $54, we could be looking at a decade of stagnation.
And that is the risk, and that is why you have to keep your eyes wide open. You can't just buy and pray this time.
Keep your file open, watch for the $54 alert, because that is the moment of truth.
We will be watching it right along with you. Stay safe out there, and please don't fight the bouncer. We'll see you on the next deep dive.
Take care, everyone.